And what's important here, and why we create a ratio for CapEx and depreciation and amortization, is that if we reduce capital expenditures, so if we say under normal circumstances, trying to grow the business, we'd spend $850 million on CapEx or whatever, and in this situation, we're just going to do the maintenance. We're just going to maintain our CapEx, but we're not going to do anything to grow. We're going to take that growth capital and use it to pay down debt. Then there's going to be a corresponding reduction in depreciation and amortization every year because you're not buying as many things, so you have less to depreciate. So, so what we see here is, this is what, our CapEx would have been. We reduced that by $300 million, so we get a new sort of reduced amount of CapEx. We get a corresponding depreciation and amortization expense reduction that's basically derived from taking a reduction in CapEx, and dividing that by sort of our CapEx to depreciation and amortization factor. And so this lets us know what the amount of depreciation will be reduced by based on our reduction in capital expenditure. Is that clear? Is that clear? Okay. So that gives us a new depreciation and amortization expense. Which gives us a new net operating profit after tax. Adjusted unlevered free cash flow. So here we start to get into some important stuff. So let's slide down and look at our debt assumptions here. So the net debt on CVS as it is $412 million, right? What we assume here is an interest rate on senior debt of 5%. Now this could easily be, 10%. And change. Change our interest expense, change the entire amount. But let's just assume to be 5% for simplicity. And on the notes, which is the equivalent of like subordinated debt, we assume 9%. Now we can change those, We change one factor here between senior and bank, between senior and subordinated notes, we can say it's 90% senior. And it's going to change the amount of interest expense associated with each interest rate and things along those lines. Here for simplicity, we chose 50-50. Here, when you look at points in a deal, those are for fees for stuff like investment banking fees, accounting fees, legal fees, points that the banks charge to loan you the money, those types of things. So we assume 1 point on the we assume 1 point on the senior debt and 1 point on the sub debt. So in fees, based on the total amount that we're borrowing, based on the total amount that we're borrowing, it's going to be about $34 million on each piece. And so what we do with that is we actually amortize that fee over about 10 years. So we write it off over the period of 10 years. And so this is actually minor, but you might as well be thorough, I guess.
So you plan to capitalize fees over a short period of time? Is that
From an accounting standpoint, it kind of depends. Yeah, but it is common, yes.
Okay.
Yeah, it is common. And so, we look at...
Capitalized instead of expense.
It's basically the same thing. I mean, capitalizing is... It's almost like capitalizing is the equivalent of putting something theoretically on a balance sheet, you know, and then you expense it by reducing it over time. So it'd almost be like, you know, yeah, exactly. It'd almost be like depreciation. It'd be like there'd be $68 million there, and then you sort of take, you know, just take it down over time. Almost like as if you prepaid your taxes, right? And you just had a big bucket of money on your balance sheet for prepaying your taxes ahead of time. But every time some taxes got, you know, every time a year passed, you have to reduce that because it's not worth anything once the year's passed, right? So it's the same kind of thing with fees in this case, and theoretically. Okay, so moving back up the model, you know, we can get a feel for what, you know, our interest expense is going to be, you know, during every year. And we get a feel for what we're going to have to pay down every year. We pay our little percentage of the amortized fee. And then what we're left with is the amount of, after we pay large amounts of interest, we're left with a little bit of money to actually pay down the principal on the senior debt. So we start with the senior because that's due first, right? So we start kind of chipping away at that.
I think you mentioned that you would pay the mezzanine
Yeah.
first. I mean, that's not senior.
Yeah, in practice you would.
First, yeah.
Yeah, in practice you would.
Interest rates are higher.
I mean, so we could make one change, and it says total other debt, and we'd be amortizing that piece. You know, but in this representation, because the senior debt is due sooner, you know, you just amortize that down. So, yeah, so in this case, you know, we start off with 3.4 billion roughly. You know, you can see we knock that down by 55. You know, we get total debt outstanding. You know, again, heavy interest on the notes. It's going to be basically the same. The interest on the bank debt is slightly less because we paid some of the principal down. So, you know, coming through to the next year, this is 5% again, but 5% on less debt. Understood? And so as we work through, you know, we get the bank debt pretty much paid off, and we're just left with, you know, a pretty significant chunk of subordinate